we'll continue to work the master budget construction with cooking hut company cases. In the video clips, we finished creating the sales budgets and cash collection and purchase and cost of goods budget with cash collections, cash disbursements for purchases, and operating expenses budget and cash disbursements for operating expense. Based on this, the Schedule A and schedule A to Schedule F, we create budgeted income statement for 3 months, but we haven't finished because the interest expense, the cash budget is not part of these schedules, right? So we need to go further with this step, cash budget, where we will find what the interest expense is. And then we'll complete this. We'll complete this operating the budget. Anyway, this operating budget provides information to construct the budgeted income statement, and budgeted income from operations is often a benchmark for judging management performance. And then we start to work with the preparing the finance budget. Okay, CHC's only planned capital expenditure is purchase of new fixtures for $3,000 cash in April. That is the only information related to the capital budget. So maybe more complex capital budgets can be dealt with the other courses or the finance courses. Then let's jump into step 3B, the cash budget. That the explaining the operating and investing and financing in terms of all the cash payment and cash collections, and financing, cash collections, and cash payment. Okay, so the cash budget is a statement of a planned cash receipts and disbursements. The cash budget helps management and avoid the either unnecessary idle cash or unnecessary cash deficiencies. The cash budget is heavily affected by the level of operations summarized in the budgeted income statement. Okay, so let's start working with this. As you can see, the beginning cash balance, we have April and May and June, less minimum cash balance desired. How much was it? So we have this information, okay? Because cash collections lag the credit sales, CHC often struggles to come up with the cash to pay for the purchases, wages, and other outlays. To meet cash needs, CHC uses short-term loans from local banks, paying them back when excess cash is available. The CHC maintains a minimum $10,000 cash balance at the end of each month for operating purposes and can borrow and repay loans only in multiples of $1,000. Assume that the borrowing occurs at the beginning and repayments occurs at the end of the month. Also assume that interest of 1% per month is paid in cash at the end of each month. Okay, those are all about the cash, the information, cash balance information. Then we have $10,000 cash at ending balance of March 31st. Okay, so keeping in that mind, let's just start working right away. So how much is the beginning balance of cash? Right, this April of beginning balance is ending balance of March. So ending balance cash is $10,000. And then what is less? The minimum cash balance desired. As we read, the cash balance information on the basic data, right? $10,000 cash balance is needed. So $10,000. Then what is available, the cash balance then? Right, it's nothing, because $10,000 exactly the same as minimum cash balance desired. Then based on all the information from the schedules in terms of disbursement or the cash receipt, we collect all the data from this, the collection from customers on the Schedule B. On the Schedule B, okay, here we go. Now we use these schedules to create the cash, the budget statement. And then payments for merchandise. Now payment, because this is cash balance, I'm using a negative sign. The Schedule D, on the Schedule D, okay, here we go. 42,700 is cash disbursement on the merchandise. And then payments for operating expense on the Schedule F. On the Schedule F, okay, minus Schedule F, payment, okay. How much is it? Operating expense is total amount, 13,750. And then purchase new fixture, and step 3A, we have $3,000 in April, the investing cash out. So negative $3,000. Okay, then what is the net cash receipt and disbursement? Okay, the sum of this portion is 13,450 is the net cash receipt and disbursement. So this is disbursement, net cash disbursement. Then what amount is the excess or deficiency of cash before financing? The available cash amount plus the cash disbursement, okay, is cash excess, excess, the deficiency of cash before financing. Okay, now how much do we need to cover this deficiency of cash? At least we need 14,000. Why 14,000? In the basic data, as we read, the CHC maintains a minimum $10,000, and then blah blah blah, and they can borrow and repay loans only in multiples of $1,000. So in order to recover this 13,450 deficiency, the CHC may borrow $14,000 from bank at the beginning of the month, right? And then let's repayments at the end of the month. There's no payment because when they, this is zero. When they borrow $14,000, maybe they have $550 on hand, but this is not the amount to repay, because again, when you come back to the information, pay and the borrow and repay loans only in multiples of $1,000. Okay. And then the less interest expense, 1% per month, end of the month. So there's no interest when they borrow money in the first place. No, they have to pay because they borrowed $14,000 at the beginning of the month, right? So this is payment they have to pay to the bank. 14,000 times 1%. So $140,000 is payment out from financing part, right? So the total cash increase or decrease from financing is now 13,860. So ending balance on April is beginning cash, and then what is Y? The net cash disbursement was 13,450, and then Z, right? So for 10,410 is ending balance at the end of April, and then the beginning balance of the beginning balance of cash on May is 10,410, right? And then what is the amount of a minimum cash? Okay, exactly the same. The available cash balance is now bigger than the minimum cash balance desired on hand, right? So that is available cash. In the collection, we put this information, we correlate that information onto the cash collection here, then we can just stretch out to June, and then we can get all those information. But we don't have the new fixture purchase, the cash disbursement on May, because the capital budget occurs only in April, right? So this is 0 and 0. And then net cash receipt, how did you calculate it? Okay, we just stretch like this. And then excess deficiency is the available cash balance plus the net cash receipt or the disbursement, right? So we can just use like that way. So until this, and then the plus borrowing at the beginning of the month. They don't have to borrow because they have the cash, the excess of cash before financing. So they don't have to borrow any money. But repayments, how much they can repay? Again, $1,000 multiple they can repay. So out of 1,860, they repay $1,000. Okay. Then what is the interest payment at the end of the month? Right, interest payment, how much is it? $14,000 times 1%. Why didn't we subtract $1,000? Because this $1,000 incurred at the end of the month repayment. So this $14,000 is the principal the company should apply into calculation of interest expense. Okay, so that is the interest, the cash out. So the total amount of cash increase or decrease from financing is decreased by 1,140, right? And then ending balance, how do you calculate ending balance? The beginning balance plus net cash receipts and or the disbursements, 1,450, right? And plus total cash increase or decrease, Z. Here you go. So 10,720 is ending cash balance at the end of May, right? At the end of May. And then June, the balance of June is $10,700, which is the same as the ending balance of May, right? So we need $10,000 as usual. Then what is the balance, the available cash balance? Okay, the same way, so 720. Okay, we have calculated already here. Then the excess of the cash before financing is 720 plus 9,400. So 10,120 is the excess of cash before financing amount. Then, do we need to borrow? Do we need to borrow money from bank? No, because we have cash, enough cash, right? So 0. Then, what is the repayment at the end of the month? Because 10,120, you see, so we can pay out $10,000. If you think $10,000, maybe it's right, but if you consider taking into account of interest, $130,000 here, let's calculate interest expense first. Interest expense, $14,000. We paid out $1,000 previous month, right? And then times 1%. $130,000. If we pay out $10,000, what would happen? 10,130 is bigger than 10,120. So it cannot happen, right? We cannot pay out the more cash than the cash than the cash on hand, right? So this amount should be negative 9,000. Okay, 9,000 is only amount we can pay out to the repay to the bank. So the total cash decrease from financing is the sum of these two, right? So 9,130 is total cash decrease from financing. So what is the ending balance? So the beginning plus then the net cash disbursement 9,400 plus 9,130. Okay, so the ending balance is 10,990. Okay, so this amount should be correlated to the cash balance at the end of the June, right? So this amount, $10,000, 990. Oh, by the way, we haven't finished operating expense on the operating budget, right? Once we calculate the interest expense here, from April to June, that amount is, okay, here we go, 140 plus 140 plus 130. So total interest expense for 3 months is 410. So what is the net income before? Okay, this is the gross margin. Oh, sorry, this already we calculated. This income from operation plus 410. So 2,990 is the budgeted income statement for 3 months. Then let's finish the income statement and then the budgeted balance sheet. The cash amount $10,990 is correlated to the ending balance here. And then account receivable net amount is 40% of June sales of $60,000 on the Schedule A. On the Schedule A, where is the Schedule A? Okay, the sales amount. Because Schedule A on the sales amount $60,000 is we collect only the 60%. So 40% is accounts receivable. So 40%, like that. So 24,000 is the accounts receivable. And then what is the inventory ending balance of inventory on the Schedule C? On the Schedule C, ending balance of Schedule C, how much is it? Okay, 48,000, right? 48,000. And then unexpired insurance, $200 for 6 months, right? So 200 times 6. So that is the amount we already paid. The company already paid from July to December, which is the prepaid, the insurance expense. It can be classified into asset because that is the right to receive the service. Okay, and then plant asset is equipment, fixture, and others. The March amount plus capital budget, new fixture, we purchased the $3,000 here, right there. So that is the March amount of equipment, the fixture and others, 37,000 plus 3,000. Then 40,000 is equipment and fixture and others. And then what about the accumulated depreciation? Also, this is, we have the ending balance of March here, the accumulated depreciation, 12,800. Then we also put the Schedule E, 1,500, accumulated depreciation, 1,500, right? So the total amount of accumulated depreciation as of June on the budgeted balance sheet is 14,300. So the total asset amount on the budgeted balance sheet is 109,890. Then finally, the liability and the equity section. Accounts payable is 50% of a June purchase on the Schedule C. On the Schedule C, the purchase is 36,400, and then the 50% of this month's purchase is the disbursements. So the 50% of this, the purchase is accounts payable. We have obligation to pay, right? So this times 50% is accounts payable on June, right? And the short-term bank loan obligation, the left amount, how do you get it? Okay, the 14,000 was the principal, right? And then we repaid 1,000, and also we repaid 9,000 principal. So the obligation is $4,000. It's a short-term bank loan amount at the end of the June. And then accrued wages and commission payable is 50% of June wage and commission on the Schedule E. Let's come back to the Schedule E. The operating expense is 17. Okay, the wage out, the 11,000, right? 11,500. Out of this, 50%. Okay, so 5,750. So that's it. And then the owner's equity is June's equity plus net income before tax for 3 months. The reason why, one of the reasons we calculated this budgeted income statement is to come up with net income before tax. That is to be accumulated into this owner's equity, right? So again, the owner's equity is including the retained earning. Retained earning is accumulated all the net income. So 78,950 should include this, should be the summed up with this 2,990. Okay, so again, this amount plus we have calculated net income before tax. So 81,940. So the total amount of this total asset and the total liability and owner's equity should be the same, right? So hopefully without any mistake. Okay, you see, those are the same. So this balance sheet is the balance can include all the cash balance and the financing information as of now, and then the cash amount is all the cash transactions, the cash receipt and disbursement from operating and investing and financing. And then this operating, the budgeted income statement is about the performance, including all the business transactions, not the cash transactions, but finally come up with the net income before tax, and that is included in the owner's equity. Okay, so this master budget is an important measurement tool for evaluating and revising strategies. For example, the initial formulation of the budgeted financial statement may prompt management to consider new sales strategy to generate more kind of demand. Alternatively, the management may explore the effects of various adjustments in the timing of cash receipt and disbursements. Okay, so it's all about the cash management, planning and spending based on the actual cash on hand that they expect, right? So let's finish this video clip and then see you the next video clip.